Good morning, everyone, and welcome to our Nordic Reward webinar. My name is Vera Campbell. I'm a partner at Deloitte Finland in our Global Employer Services team, where I work with reward and workforce issues. And once again, I will be one of your hosts here in the studio, together with Minna.
Hi, Minna Markusson, working here in Deloitte Finland with Vera, especially on the rewarding services.
So, as most of you know, this is our third and final part of our three-part webinar series on share plans. We started with looking at the plan design. So how do you make sure you design a plan that works for you globally? Then we looked at communication. So how do you really take the message across to your employees, and how do you make sure they understand the plan? And today it's the final complete circle. So we will look at the upkeep and maintenance. So how do you keep your share plan compliant throughout the life cycle of the plan? But let's have a look at today's agenda.
So we have scheduled 1 hour for this webinar and are going to keep to that timeline as well. We're starting with Therese going to about the Nordic Deloitte team and also our rewarding services in short. Then we are going to our main topic of upkeep and maintenance of equity plans. And then we are ending with the questions and answers section, where we'll be answering as many questions as we can within the time limit. So we ask that you will be inputting your questions to the chat, so we can then answer those at the latest at the end of this webinar. And Therese will continue from here.
Yes. Hi, everyone. So my name is Therese Nilsson, and I'm leading the equity and incentive team in the Swedish firm. With us today, we also have Matt and Rob, but I will let you two introduce yourself shortly. We do see that there are a few new participants also for this session, so I'm just going to give a very quick introduction to our reward services. You can see them on this slide summarized. We do have a broad variety of services. So we have specialists focusing on employment tax. We have a team working with pension and benefits. We support with exec comp and board advisory, reward connected to M&A deals. We also work with pay equity and the pay transparency directive that is high on many or most companies' agendas nowadays. And of course, we do end-to-end services within the equity and incentive space, where we are with today's topic for this seminar. If we look at the next slide, we see the Nordic team, because within the Nordics, we work very close together. We are a team of close to 40 advisors now. And on this slide, you can see the contact details to our country reward leaders. And you're, of course, free to reach out to any one of us with reward questions, or if you do have follow-up questions from this seminar, for example. We also have very close collaboration within EMEA, and that's why it's so nice to have Rob and Matt with us today, joining from the UK. And they're going to walk us through the maintenance and upkeep of global share plans. So I think with that, I will hand over to you, Matt and Rob, for you to introduce yourself and today's topic.
Thank you, Therese, and good morning, everyone, and welcome to this session. My name is Matt Steers. I'm an Associate Director at Deloitte UK, and I'm a tax advisor and lawyer, and assist companies with the design and implementation and then the ongoing operation of incentive plans globally. And I'm joined today by Rob Jennings, so I'll let Rob introduce himself now.
Morning, everyone. As Matt says, I'm Rob Jennings, a director in our equity and incentives practice based in London. I'm a tax practitioner by background and look forward to speaking with you today. Matt, back to you.
Thanks, Rob. So we're delighted to be with you this morning. As the team have mentioned, this session is really about the upkeep and maintenance of an equity plan. And what we really mean by that are the key tax and legal considerations which need to be taken into account when you're designing an equity plan, and the ongoing considerations throughout the life of the plan to ensure you are compliant when you're operating the plan globally. So at a high level, we're going to be looking at what those key tax and legal considerations are, why those considerations are so important, then the time at which you need to take those considerations into account. Following that, we'll go into a little bit more detail in terms of what the real tax and legal considerations are. We'll look at some key jurisdictions around the world that always pop up and always need to be considered in detail. We'll also consider the implications for internationally mobile employees, so you've got a better understanding as to the considerations you need to take into account and the particular nuances that internationally mobile employees throw up. And then finally, we'll touch on employee communications, not necessarily the same communication as the last session. If you join that session, this is more focused on the topic we're covering today, but equally something that's really important. And as Minna said, we'll have time for Q&A at the end. Okay, thank you. If we could just move on, please. So just to set the scene, this slide shows common equity structures in both Finland and Sweden. So, for example, in Finland, it's typical to grant restricted or performance stock units, which will deliver shares for free, subject to the satisfaction of certain conditions. For example, a service or a requirement to remain in employment, or subject to performance conditions. And in Finland, that's an arrangement which will result in income tax and social security arising at vesting. So there are no tax advantages. Alternatively, in Sweden, it's really common to grant warrants, which participants are required to pay market value for. And that's common because it offers tax advantages in Sweden. In particular, that there are no income tax or social security liabilities due in relation to the warrants, and capital gains tax is due when the shares acquired from the warrants are sold. However, in both cases, it's really important to understand the implications of those structures in other jurisdictions. If we look at Finland, for example, it might be possible to optimize the structure of an equity plan from a tax perspective in other jurisdictions. And if it's possible to do that, it's really important to know how you could do that and what you need to do to actually implement an optimized structure in other jurisdictions. In relation to Sweden, it's really likely that actually the tax advantages enjoyed by participants in Sweden will not be enjoyed by participants in other jurisdictions around the world. And in relation to warrants in particular, the tax treatment can differ around the world. And that makes it really important to understand what the implications are going to be when designing and operating a plan around the world. And this session is really focused on that theme, really understanding what the implications are going to be. Of course, this slide focuses on the broad structure, but on the tax treatment as well. The legal implications, which I'm particularly concerned about, are also need to be taken into account, and different structures can have different legal implications around the world. So that's the real focus of the session today. Okay, thank you. I think we can move on.
Hi there. So, do you want me to kick off on the tax side?
Yeah, so you can go through the tax. Yeah.
Brilliant. Thank you. So we're going to come back to some of this in a slide or two's time, but just to sort of set the scene, I guess when we're looking at the tax side, just fundamentally, we just got to understand the tax and social security treatment of these share-based incentives. And I think, at the risk of stating the obvious, it's not necessarily the same as cash salary. When you pay your cash salary to people, you would often have income tax and or social security through pay or withholding. The analysis does not hold necessarily the same for share-based awards. So first of all, you have to understand, is the share-based award taxable at grant? Potentially, you want to try and avoid that, but potentially at grant. Is it when an RSU or PSU would vest? Or there might be some countries where there isn't a tax charge at vest, but the tax is deferred until sale. Maybe that happens automatically if you meet certain conditions. Maybe, as Matt says, if you've implemented some kind of tax favored structure, what is it that you would need to achieve that? Once you know what the tax point is, you need to understand what the withholding requirements are, and they can be different for income tax versus social tax. And again, you might find that an equity award, if it meets certain conditions, may potentially be exempt from social tax, whereas salary would be subject to social tax. So there can be differences between a share-based award and a cash-based award. Similarly, payroll reporting. Sometimes you would often have to include salary within a payroll report. It doesn't necessarily flow that it's the same for equity. And often it's linked to that. Is there a withholding obligation? Is there an employer involvement? There can be some specific equity reporting. We'll come back to that in a slide or two's time. But we also have to think about corporate tax deductions around shares, because there's a lot more complexity as a general rule in relation to corporate tax deductions versus salary. Finally, with share-based awards, they'll often have a life. So between when the award is granted and when you deliver the shares, it might be 3 years. So if you've got a person moving from country A to country B, there's a much greater chance that you're going to have to consider multiple countries' tax systems, and how does each country want to tax that award in relation to a mobile employee. So we'll come back to some of this in a slide or two's time. Matt, do you want to just touch on the legals?
Yeah, thanks, Rob. So as Rob mentioned, we'll come back to these and cover them in more depth in a slide or two time. But the key considerations from a legal perspective in relation to an equity plan, starting at the top there, are the securities laws. So each jurisdiction will have its own securities laws requirement. In the EU, generally there is harmonisation with the EU PR, but even in the EU, the application of that can differ. And then outside of that, obviously, there are vastly wildly different regimes. We need to look at exchange control considerations. Some countries have real restrictions on transferring money into and out of a jurisdiction, which can impact the operation of a plan, and potentially, completely or make the operation of a plan, not viable at all. We need to consider the employment law considerations in each jurisdiction. How will the courts interpret provisions within the plan? Are there any risks from an employment law perspective that a company needs to be aware of, or do any amendments need to be made? Translation requirements is an important one, whether there's a legal requirement or whether you would like to translate plan documents, even where there is no legal requirement to do so. That might help participants to understand the terms of the plan and the terms of their award. Data protection is obviously one that is increasingly important around the world. In the EU, obviously GDPR is very prevalent, and again sort of generally harmonized, but there are different regimes around the world that you need to be aware of when operating a plan. Payroll deductions isn't necessarily applicable to every equity plan, but depending on the type of plan you have, it's really, really important. In some jurisdictions, making payroll deductions is unlawful, or there might be some particular requirements that you need to adhere to, and electronic agreements as well. So, entering into contract electronically, and whether that is possible as part of the equity plan. Okay, thank you. If we can move on to the next slide, please. So this really focuses on why these considerations are so important. So as we've discussed in relation to the typical structures in Finland and Sweden, those structures may not translate globally particularly well, or there might be considerations when doing so. And if that is the case, it's really important to know about that as early as possible in the design phase, or to be aware of the implications during the life of the plan. And as we've touched on, one of the considerations may be optimizing the structure from a tax perspective. And if that is possible in a particular jurisdiction, it's likely to require specific consultation with local advisors. For example, in In the UK, it's possible to optimize the structure of in some incentives from a tax perspective, but there are really strict legislative requirements and an addendum's likely. So it's something that's really important to consider separately. As we've touched on, securities laws, the filings and the registrations is really important, particularly because securities laws, fines and requirements can be onerous in certain jurisdictions around the world. Regulators take a really hard line approach in relation to securities laws. So we're really understanding those requirements is very important. And ultimately, a lot of the considerations here relate to being compliant. Operating equity plans is complex enough, and then extending them globally adds another layer of complexity. So reviewing all the tax and legal considerations really provides you with some comfort that you'll be compliant in each jurisdiction in which the plan is operated. Rob, do you want to?
Sure. Yeah. So it very much linked with kind of the top row of this slide. There will be some countries where, for a tax or a legal reason, you just have to make the decision not to move forward with the plan in that country. Maybe you can change it, but there might be a hugely onerous filing. And if you were planning to grant an award to a relatively small award to an employee in a location, but this would trigger significant filing requirements, or maybe it's a large award, but it would trigger an adverse tax charge. So an upfront tax charge, which creates genuine risk for a participant. There you might have to sort of, if you get the due diligence, and you might just have to decide, either we'll amend the award, maybe we'll do a cash-based award rather than a share-based award. Is that going to solve the challenge that you are facing? Or you might decide it is not appropriate to move forward at this time while we've got such a small population, because the amount of work that would be created for yourselves, the central team, plus potentially your local teams, is just disproportionate to the benefit that would come from allowing that participant to participate in a scheme. There might be some countries where you can move forward, but you just have to take some particular care. The US is obviously a very big jurisdiction where if companies looking to grow, they might want to extend their operations into the US. There are quite a few challenges from a tax and legal perspective in the US. They're usually all manageable, but they do require a little bit of thinking. Then, in terms of the employee experience, you want employees to feel engaged. The whole point of these plans is to incentivize, retain, and motivate employees. If they don't understand the plan, they kind of suffer an adverse tax charge, or there's additional work created for them and they don't know about it. All of a sudden, it becomes not an incentive, it's quite the opposite, and it can become a bit of a disincentive. And in the UK, for example, lots of employees wouldn't necessarily file a tax return, but in the UK, we have a tax advantaged plan called the SAYE plan, which allows companies to deliver options, and then the employee pays capital gains tax on that, but that then potentially triggers a tax filing obligation for the participant that they might not have otherwise had. What lots of companies have done recently is much more of an education. So I know the session was around last time was around employee communications. This is employee communications with a bit of more of a tax slant, just so that employees understand their obligations. They go into the plan with their eyes wide open. They know what they're getting themselves into, and they're given the support by their employer when they participate in the plan. If we can move on, please.
Thank you. So we're just going to talk through when these considerations need to be taken into account. And there are multiple stages in the life cycle of an equity plan that they do need to be considered. But the first point in time that they really need to be considered is when you're designing the plan. And it's particularly important to review the considerations at this in the design phase, because the structure of the plan is likely going to drive the tax implications around the world. If you design a plan which delivers for you commercially, but which is impractical from a tax perspective, the company and the participants could be, left with larger tax bills, unintended consequences or surprises. And just touching on Rob's point there in relation to, employee experience, and the plan may not ultimately work as an incentive due to the negative perception from participants or elsewhere within the organisation. And as we've mentioned, the structure is also really going to impact the legal implications. For example, the securities laws considerations or employment law considerations. Leaver provisions within the plan is something that can really impact the employment law considerations. If you complete a review of the tax and legal requirements at the design stage, you'll understand all of your obligations at the outset, and that's going to reduce the risk of non-compliance during the life of the plan, and reduce the risk of any penalties arising. But it's also going to allow you to alter the structure of the plan in a particular jurisdiction. For example, altering the structure in a particular jurisdiction may ease the administrative burden associated with filing requirements, or you might be able to reflect local employment laws within the plan in a manner which will then enable you to operate that in a much more compliant way moving forward. And having that ability at the outset is really good, because you can impact the design of the plan, and then effectively you're not then trying to fit a square peg into a round hole further down the line. So an approach we normally take in relation to the design of the plan is to produce what's we call it a red, amber, green or RAG review. And this is a review which is completed at more of a high level and identifies the key tax and legal considerations to enable you to alter the design of the plan. So going back to Rob's point around identifying showstoppers and looking at those really key considerations, that this red, amber, green review helps to identify those showstoppers. And this gives you, the opportunity to say, okay, we would like to commercially or implement a plan which commercially delivered in this manner, but we're going to tweak it in certain ways because we know that there are particular considerations in the US or France or wherever. So the second point at which it's really important to consider all of these requirements are when granting awards to new employees in a different jurisdiction. It's very common to exclude participants in some jurisdictions initially, for example, where there are very few employees in a particular jurisdiction, but then over time, the number of employees in that jurisdiction can grow, and then, or you may hire a really senior individual into a particular jurisdiction, and at that point, you then want to include that individual or those individuals within the incentive plan. And it's really important at this stage to review the considerations for the reasons that we've discussed. You might have less flexibility at this point to amend the design of the plan, but you do still need to be aware of the requirements before implementing the arrangement for the same reasons that we've discussed. From a tax perspective, there may be, if you're only granted a very small number of employees, there may be a, huge risk associated with that. But from a legal perspective, it's certainly in relation to security law, there are, the considerations are equally important. And, it's really, really, really important to get an understanding of what those tax and legal implications are when going into a new jurisdiction, and not simply go ahead and grant the awards. It's, as Rob mentioned earlier, again, another opportunity for you to alter the structure of the awards within the parameters of the plan you already have, for example, by granting cash awards, because that may be more beneficial from a tax or legal perspective. The third point on this timeline is, again, relates to extending the plan, but in a different scenario. For example, you could extend the plan to a completely new subsidiary. For example, after a corporate transaction, you may have purchased a subsidiary in a new jurisdiction, and you might want to extend the plan to all of the participants, all of the employees within that jurisdiction. Again, the same considerations apply here as to why it's really important to consider the tax and legal implications. But given if it does relate to a corporate transaction, because that's such a a busy period, easy to go through that process and automatically include the new employees within the equity plan without first considering the tax and legal implications of doing so. And of course, the greater the number of employees included within an equity plan, the greater the risk from a compliance perspective, and ultimately, greater the risk of consequences with the local tax authorities. And finally, on here, we have a periodic review of the requirements. As you know, the tax and legal implications can change over time. Tax implications can change, annually, legal implications too, but tax possibly more frequently. So it's really important to, once you've designed the plan and understood all of the implications, to periodically review those requirements. And you might do that every year or every other year, depending on the size of population in a jurisdiction or your risk tolerance or the particular jurisdiction. And that's really, really important, as I say, to make sure you understand how the requirements have changed, and then you can alter your approach in that jurisdiction to reflect any changes. Okay, thank you. I think we can move to the next slide.
I'll jump in here, Matt, if that's okay. So we touched on some of this before, but we're kind of a little bit repeating, but effectively, once you know what the plan you want to offer, you want to understand what's the tax point, what's the taxable amount, is it income tax, is it social tax, is there payroll withholding in the same way that you might have for cash, for example. And I think to a degree that's self-explanatory, but again, there are opportunities for tax optimization. Can we say that actually if we do this tax optimization, maybe we could push the tax point from vesting of an RSU to sale of the shares, and maybe that's at more favorable rates? I think there's a few points that, in terms of the taxable amount, as a general rule, the taxable amount would be the value of the shares on vesting of an RSU, for example. But there are a couple of countries, Italy, India, where they have specific requirements around how to value a share for tax purposes in that location. Again, do you understand the employer and employee reporting? Now, some of that is, in terms of the employer reporting, some of that is payroll reporting. You put the share benefit through the payroll, you have payroll withholding and or social taxes through payroll reporting. But some countries, the UK is one of them, Australia is another, where there are specific additional share plan reporting requirements. So in the UK, after the end of the UK tax year, there is a 3-month window, effectively, where companies have to file these annual returns. There will be lots of other countries where it is additional reporting requirements that are completely separate and kind of additional to the usual payroll reporting. When it comes to corporate tax deductions and recharges, the two sort of comments on the top right sort of work together, because in many countries, if you pay someone a cash salary, you will get a corporate tax deduction for the cash salary that you pay to a participant. The rules around corporate tax deductions for share-based awards are much more complex, and quite often you need to make the German subsidiary bear a cash cost, i.e. the parent company must basically make the German subsidiary pay a cash cost in order to get a corporate tax deduction in Germany. Then you might need a specific recharge agreement in place to achieve that deduction. But then you also need to understand if that could have an impact on the employment tax position, because some countries would say, well, if there is no recharge to the local subsidiary, the local subsidiary is less involved in the share award, and maybe you don't have income tax or social tax withholding. But if you have a recharge to the local entity is more involved in the share plan, and therefore that might all of a sudden impose a payroll withholding obligation and or a social tax cost. So it might be a good thing to implement a recharge to get the corporate tax deduction, but just make sure that we're aware whether it might impact the employer obligations that we might have previously thought were not our responsibility. Maybe we thought it's an employee responsibility, but now if that means that there isn't a withholding obligation, we just need to be aware of it. Again, usually all manageable, but just things that we need to work through. Matt, you can move on to the next slide, please.
Thank you. Yeah, so as we've touched on, so these are the key legal considerations, and we'll just run through them in a little bit more depth. So the securities laws considerations is really one of the principal considerations. And ultimately, this relates to whether a prospectus is required to offer securities in a particular jurisdiction. And that's really important because completing a prospectus is really onerous, costly, and time-consuming. So identifying whether any of those requirements arise in a particular jurisdiction is really important. Now, what we're really looking for is an exemption from the requirement to complete a prospectus. But in many cases, an exemption comes with a requirement to submit filings to the regulator. And those filings could be one-off filing, or they could be filings which need to be submitted on an ongoing basis. So again, any filings that need to be submitted will have a cost, time, and monetary, but any ongoing filings really can impact the cost of the plan. And you need to understand where those filings are going to be required and who internally is going to be responsible for them, so you can ensure that they are completed. Exchange controls, again, as we've mentioned, there's some jurisdictions have really tight restrictions on the transfer of currency into and out of the country, and we'll touch on a couple of those jurisdictions slightly later. And that really can impact the operation of an equity plan. For example, if there is an exercise price associated with the awards, remitting that across border, for example, if we go back to the warrants in Sweden, that might not translate to some jurisdictions where there are particular exchange control considerations, or even then transferring sales proceeds cross border can have, there can be real restrictions on that. Employment law is another one we've touched on. Principally, what we're looking at here from an employment law perspective is to identify whether participants will gain a contractual right to receive equity awards as a result of those awards being granted on a continuous basis. That isn't something that you as the company will want to happen. You don't necessarily want to have a contractual right to deliver equity awards to individuals. So that's what we're looking at here, and we're identifying whether there is any wording that we can include within the plan to reduce the risk of that contractual right arising. Equally, we're also looking at the leaver provisions. If there are, each equity plan has leaver provisions, whether that's good, bad leaver provisions. But in some cases, in some countries, the courts will look at those leaver provisions and will not respect them and actually determine that they're void and not workable. That's particularly relevant in Europe, so Germany, France, Spain, etc. And it's something that's really important to be aware of. Not that you can necessarily solve for all of those problems. In some cases, there is just going to be an inherent risk with operating an equity plan, but you need to have the information so that you can make a commercial decision that actually you are going to operate the plan in a jurisdiction like that, and just recognize there may be a risk from an employment law perspective. And again, equally, so payroll deductions is another one we've talked about. This is really important where you've got a purchase plan, where you're actually making payroll deductions, but in many cases, it's either not lawful to make payroll deductions, or you need to have consent from either participants or in some limited cases, the government. So Malaysia is an example there where you need consent from the ministry in order to make those payroll deductions. So again, it's something really, really important to be aware of and make sure that you have the consent in order to make those payroll deductions. Translation requirements, again, in some cases, in some jurisdictions, there's a legal requirement to translate plan documents. So Quebec is an example there. There's an obligation to translate into French. And as I mentioned earlier, even where there's no legal requirement to translate into local language, you might actually want to translate anyway. And in some countries, it's more recommended than others. And that's because it will increase the enforceability of the provisions within the incentive plan. We go back to the good and bad leaver provisions. Actually, translating the documents into the local language reduces the ability for a participant to say to a court, well, I wasn't aware of the good and bad leaver provisions because the plan hadn't been translated into local language. So that's another consideration that we'll pick up as part of the review. And data protection, again that's increasingly important around the world. As I mentioned earlier, in Europe we've got GDPR, that's harmonized generally, but it's really important to make sure that data is transferred in accordance with each jurisdiction's data protection requirements, particularly where there's a third party involved that might be handling employee participant data as part of the process. And all of that means that you'll have a better idea as to whether any amendments to the plan are required, to reflect the requirements in a particular jurisdiction, for example, the employment law consideration, or whether there are, particular amendments that need to be made to individual award documents. Okay, thank you. I think we can move on to the next slide.
Should I jump in, Matt? So
yeah.
Again, these are sort of, when Matt and I were sort of chatting about this deck, these are sort of some of the countries which we commonly see as being kind of a challenge or something to navigate. I'm not sure, we're going to have a mixed group on this call of, I don't know which of those countries that you've seen, but Matt, do you want to, I'll do Singapore just as an example of a tax challenge, and then do you want to just do the US? We could spend an hour going through some of these, but for Singapore, when it comes to share-based awards, for domestic, it's generally fine. For a mobile employee moving into Singapore, you can get quite a nice situation actually, because Singapore won't actually levy the taxes if you weren't in Singapore at grant. However, there's a bit of sort of a sting in the tail, in the sense of, if you're in Singapore with a share-based award and then you leave Singapore, you're generally you have a deemed exercise. So Singapore will tax you when you leave Singapore, based on the kind of the value at that point in time. Now, there can be complexities, and maybe you can recoup some of those taxes if the award is subsequently forfeited or what have you. But I think the point is that most of the time you're expecting the tax point to be at vesting, fine. But then when you're in Singapore at grant and then you leave Singapore, it can just have a nasty accelerated tax charge that you just have to then manage. So that's in the context of mobile employees, and we're going to come back to mobile employees briefly on the next slide. But again, Matt, do you want to just touch on the US? We could go through all of these, but we need a couple of hours. So if you want to just touch on the US, because that's going to be a common for many.
Yeah, of course. So there's two considerations there on the slide in relation to the US. The first is the securities laws requirements, and the US is particularly important because you have to consider the securities laws at both a federal level and in relation to each state in which any share plan participants reside. So each state will have their own requirements. In many cases, the state requirements will follow the federal requirements, in that, as I mentioned, there's an exemption from an obligation to publish a prospectus. But in many states, there is a filing obligation in order to benefit from that exemption. And then there's an ongoing monitoring requirements, because there are limits and thresholds that apply. And if you exceed the thresholds, then there's either additional disclosure obligations or further, or that particular exemption may not be available. So it's really important to understand A, the federal obligation, but B, the states in which your participants are residing, and get an understanding of the requirements there. New York and California are two states where a filing obligation arises, and again, so that's two very typical states in the US. And so from a tax perspective, we have US Section 409A, and that's important in relation to any in form of incentive award in the US. Effectively, it is an anti-avoidance provision which aims to ensure that participants aren't deferring tax into subsequent tax years, but the effect and the impact on share plans is really quite significant. And if an incentive is implemented in the US and Section 409A isn't considered as part of the design or structuring of that plan, then the participant can end up with a penalty tax of 20%. And again, that just goes back to the employee experience. It's really, really nasty and difficult to unwind from a US tax perspective. And ultimately, it's probably something that's going to be costly for the company, because although it's a participant penalty, normally it relates to an error in relation to the operation of the plan, and the company generally funds that liability. So again, it's something that's really, really important to consider.
Thanks, Matt. Should we move on to the next slide, please? Internationally mobile employees. So we could spend an hour on this slide alone, but I remember that fundamentally share plans is a challenge. Internationally mobile employees is a challenge. So when you put the two together, not surprisingly, it is an extremely complex topic to navigate. Firstly, because there's multiple countries involved. It could be two, it could be more. Because an award might typically have a life of, say, 3 years, and therefore there's a lot of chance for an employee to be moving location from country A to country B during that 3-year period. So you have to track the employees over the life of the award. You need to know their facts and circumstances. Is the individual moving on assignment, or are they moving as a permanent transfer? There are going to be different complexities, different challenges. Are they tax equalized on their income? And again, this is a whole raft of issues, but fundamentally, sometimes you might have the countries that will not tax people. So as I mentioned earlier, that if you're not in Singapore at grant and then you move into Singapore, Singapore wouldn't actually tax it. That tends to be the exception. Most countries will want to tax some or all of the award. And then you get into challenges. Well, if country A wants to tax some of the award and country B wants to tax all of the award, do you have double withholding? Do you have double taxes? How can you alleviate any potential double taxes? Can you do that at the withholding stage? Is the individual going to have a very high withholding rate because of the countries that they've moved into? So if you move into Canada with a share-based award, the starting point is that Canada wants to withhold on 100% unless you have a specific waiver. You can they will give a foreign tax credit in the Canadian tax return for the overseas taxes, but if you move towards the end of a vesting period and the home country wants to withhold, if it was say the UK would want to withhold at rates of up to 45% on the UK source portion. If then Canada wants to tax all of it at the withholding stage, you end up with very high withholding rates. And the individual might have to pretty much sell all of their shares to cover the taxes due in the UK and in Canada. It gets alleviated in the tax return, but from a cash flow perspective, it isn't ideal. So we talked about income tax there, but we have similar challenges around social security. There are countries where there are social security agreements and other countries where there are not. So once you've got to understanding the tax obligations for your domestic employees and the legal obligations, if you then have cross-border employees moving during that 3-year vesting period of an award, there are going to be considerable challenges in terms of income taxes, social taxes, withholding obligations, reporting, relieving any double taxes. It's a minefield, it's very challenging to keep up with it all, but you need to understand and make sure that you are fully compliant, because all the tax authorities are aware that mobile employees is a challenge, and therefore they do tend to scrutinise these arrangements quite carefully, especially if those cross-border employees are your senior individuals who may have larger share-based compensation awards. So again, we could talk for an hour on this, but I'm very conscious of time. So if we move on to the next slide.
Thanks, Rob. So as we mentioned earlier on, there's an element of this which relates to the employee communications. This isn't the broader employee communication considerations that were covered in the last session. What we're talking about here are, employee communications, which really set out the tax consequences of participating in a plan. And it's really important because it gives, you as a company the opportunity to provide the technical details of the plan to participants. So these communications will, give employees and participants the personal tax implications as a result of participating in the plan. And as we've mentioned, that's really important for them if they're going to understand the plan, their obligations, and ultimately to view the plan positively. For example, an employee guide, might set out the implication on a sale of shares, which in many jurisdictions may result in a requirement to pay capital gains tax and pay that amount through a personal tax return. As Rob was saying earlier on in relation to the SAYE in the UK, this is particularly important because, you've got a large number of employees who are not normally or not used to submitting a personal tax return, suddenly found suddenly having an obligation to do so. So if this information isn't provided to employees, they're going to be left in the dark and ultimately not, as we say, not going to view that incentive positively. So in addition to all of the tax obligations, the guides will, set out employee reporting requirements. All of those reporting requirements may be linked to the personal tax return, but, might include other things such as foreign asset reporting. In many jurisdictions, there are separate forms that are required from a foreign asset reporting perspective, and obviously holding shares is something which could trigger the foreign asset reporting, depending on where those shares are held. And one of the real key reasons for providing this type of communication is to reduce the number of queries you receive internally. As we've mentioned, operating an equity plan is complex, and employees will find it complicated if they're not used to this type of arrangement. So these guides really act as an FAQ style document from which employees are able to obtain, the important information, the key information they need. And that's really important for you as a company to manage your workload so that you're not responding to the same queries over and over again. And ultimately, as we sort of mentioned a few times, this really comes down to, the employee experience and preventing nasty surprises and giving the employees, the information that they need. There is a balance, of course. You've got to be careful that and make sure that you're not providing advice to employees on the personal tax situation. So, any guide and any information in the guide have to be given on a general basis, but that's very common. It's just something to be aware of. Okay, thank you. I think we can move on to the next slide. So this slide really just sets out all of the different considerations in relation to the design, implementation, and then operation of an equity plan. We've touched on some of the areas here, and in the first session we talked about design with Liz. We've had communications with Fitch. Local payroll support, GA incentives is a technology tool that relates to internationally mobile employees, but it just sets out all of the considerations that need to be taken into account. Obviously, this will touch a large part of your organisation, and it's they're all areas that you know we're very well versed in and help clients with on a regular basis. Okay, well, thank you very much for your time. That's the end of our presentation. So we've got 10 minutes now for Q&A.
Thank you so much. Very interesting. We do have some questions. I think I'm gonna choose one which concerns the timing of performing the tax review you've spoken about. So the question is if we should do the tax review immediately before the grant, prior to vesting, or at both stages, if the client is also gonna consider budget constraints and compliance requirements, how to balance that. So basically how to make the decision on when to do the tax review, I think.
Do you want me to jump in on that one, Matt? Okay, so I think before grant, you've got to understand the key features of what is the tax point, because if you know that a grant would be taxable, sorry, the grant would trigger a tax event, you need to know about that, and you might decide not to move forward with granting awards in that country if it's going to create what we call a dry tax charge. Now, if you do, so I would say you do need to do at least a high-level review before grants are made from a tax perspective. You might then decide, and if we find that, let's say, all of your countries were going to tax a Finnish-style RSU or PSU award when the awards vest and shares are going to be delivered to the participants, then if you've got comfort that that's the position, you can go ahead with granting from a tax perspective. But then as you get closer to the vesting, that's when you might need to do a more detailed analysis. You're ahead of your first vesting to understand your full withholding obligations, your social tax withholding obligations. Is there any additional reporting requirements that are triggered as a result of awards vesting? So there is a balance. I think as a bare minimum, you know, again, it kind of depends on the size of your population as well, because if it's a huge country, you might want to do a fuller analysis up front as well, because also you might have people who are going to cease employment. What's going to happen if someone ceases employment? Would you accelerate the awards and release the awards early? In which case, again, you need to understand what your withholding obligations are. So it's a great question. It's not easy to get it right. As a bare minimum, you have to do that high-level review just to understand when taxable events and tax obligations for the employer are first going to be triggered. If you get to the stage where, okay, we can get comfortable that taxes are going to be triggered on vesting, or maybe you hold off doing the deep dive in terms of withholding on obligations and how to calculate the taxable value, and then you can do that deeper dive a bit closer to the vesting. Because as Matt said, tax obligations do change. Sometimes a country will introduce a withholding obligation where there wasn't one previously. So
thank you so much. There are some more questions, but I think maybe we should stop there so we don't run over time. But to the audience, if there are any additional questions, please put them in the chat and we can try to come back to you separately on those questions. I see there are some that we haven't had the time to answer now, so we'll come back to you on those. And with that, I think I'm going to hand over to you, Vera and Minna.
Yes, thank you, Teresa, and thank you, Matt and Rob, for the interesting look into the maintenance of the share plans. And I think it's a very topical issue because of the kind of LTI season, as we call it. So companies are starting to prepare for the spring payouts and, of course, granting new awards. And thank you to everyone who joined us this morning, and a special thank you to all of you who joined us for all 3 of our webinars on share plans. And thank you for the feedback. It's been great to hear that you have found these sessions useful. If there are any other topics on reward you would like us to cover, then do please let us know. And if you have any questions about today's session, then reach out to Minna or myself or any of the speakers today. So with that, we wish you a great rest of the day. Thank you.
Thank you.
Thank you.